I'm going to be talking on a subject that I've been working on for a few years now with a number of co-authors. And I guess it started post the financial crisis. And I started looking at models of the economy in which we started abandoning the law of one price. And initially, I was just toying around with working with what happens when we do this, and things started developing in the direction of trying to do it not only in static models, but finally in continuous time models. And then I learned last summer, connected up with the work of Shige Peng in China, and Dilip Madan and others who have been developing the theory of nonlinear expectations. And it turned out that what I wanted to do actually links up with nonlinear expectations and also links up with the theory of nonlinear martingales. And so I will show you how these things all connect up and where things are moving in this particular area. Now, there we go. So the basic outline is I'll first speak about the role of financial primitives in economic modeling, where they come up or how you can bring them in. Classical models of an economic equilibrium have no financial primitives at all, and finance then is not relevant, and that's the first thing we teach our students. But in a model in which financial primitives appear, then you begin to see how finance determines the size of the real economy. I'll then move on to the task of modeling markets directly, rather than trying to model individual behavior and think of models of the market as an aggregate of humans. We think of, I will talk about markets as abstract entity to be modeled directly. And essentially one is talking about modeling the Walrasian auctioneer in the classical model, but this is a Walrasian auctioneer in a two-price economy. And I will show you what comes from there. What actually comes from there is a theory of two-price equilibria. So in equilibrium then, for all the transacted commodities and all the transacted contracts, what you get in equilibrium is two prices. There is no one price at which you can transact in both directions. So we learn what two-price equilibria look like. And then I say, okay, that's an abstract theory. You can write lots of papers. You can prove lots of theorems. But I would like to be able to actually compute these prices and equilibria and use them for various applications. And that takes us to constructing these equilibria using what's called probability distortions. So I will show you how to actually compute two-price equilibria using probability distortions. All that happens in a static one-period model. I then go on to looking at these things dynamically in discrete time first, because after all, that's the first thing one can do from a static model. I didn't know how to do continuous time stuff until last summer. And last summer was when I met up with Shige Peng and learned what he calls G expectations. And then I built G expectations based on probability distortions to construct nonlinear expectations. So I will show you what nonlinear expectations are, how they're constructed, and how we work with them. And I first did this using probability distortions. That's a paper that's forthcoming in the Annals of Finance now. And however, I was looking at limits of discrete time economies and trying to go to continuous time with it. And there we learned that you could actually construct G expectations directly without having to use probability distortions, which of course you need to do in continuous time when you're dealing with the processes that have infinitely many jumps, like my variance gamma or gamma processes. Then you need to be able to deal with distorting complete measures rather than distorting just probabilities. And so we basically learned how to build G expectations with measure distortions that are related to nonlinear partial integral differential equations. Now the question is, a nice thing that appears is a meta theorem, not yet proved, but I believe someone, or maybe ourselves, we might get there. But there's a meta theorem that relates nonlinear martingales to arbitrage theory in two-price economies. If you have a two-price economy and it is free of arbitrage, then you can pretty much, I'm sure, show that the two prices will be nonlinear martingales. And so nonlinear martingales are to arbitrage theory in two-price economies as martingales are to arbitrage theory in one-price economies. So that's a nice takeaway from what's going on here, but of course that's conjecture at this point. It's not been proved. Then I will relate these two-price concepts to formal approaches to risk-weighted assets, to defining capital and modeling leverage, and finally to talk about marking to two-price markets as to how you go about marking. I say, okay, we like to mark to markets, we think marking to markets is a good thing, but how do you mark to two-price markets when the law of one price has disappeared? So financial primitives point out that the basic model for an economy takes as primitives preferences, endowments, technology. This is the Arrow-Debreu economy that we all learn when we start general equilibrium theory. And in that economy, all people can transact at the prevailing prices. Basically, your ability to transact comes as a birthright. The fact that you can walk the streets entitles you to trade. The abstract entity termed the market, which is the Walrasian auctioneer in the model, just seeks price systems that clear markets. So the Walrasian auctioneer is looking for the law of one price that will clear markets. And that's all the abstract entity is concerned with. It's a very simple model of the Walrasian auctioneer. We will actually modify that and introduce financial primitives in the model for the market. So here in the classical model, there are no financial primitives. Preferences, endowments, and technology are not financial considerations. And so finance has no economic relevance, since we all know mathematics, that if something is not in the assumptions, it's not going to show up in the conclusions. So enter financial primitives. How do they enter and why do they come in? So in the model I construct, no one can transact without financial approval. Basically, if you don't have a credit card, don't try to trade. And so the financial system comes into existence, and a financial primitive comes into existence by defining who has the ability to transact and how much. How will they trade? So it may be necessary that the approver that approves all people for trade and how much they can trade, it may be necessary that this approver is actually TBTF, too big to fail, because otherwise it may well be that they're too small to deliver. Because what they're trying to deliver is absence of failure in transaction. And if you're trying to deliver the absence of failure, maybe it's important that you be TBTF rather than TSTD. What are the concerns of the approver? The main concerns of the approver are that the set of events on which an economy lives is larger than what can be contracted. As a result, I say that market clearing cannot be attained in all states. Endowments can disappear. My great-grandfather took care of farmers when crops failed for many years at a time. The financial system is there, not just money is not there and finance is not there just as a medium of exchange and a store of value. Its job is essentially to cover losses related to the absence of clearing. When markets do not clear and people and agents need to be, losses need to be covered and taken care of, that's what the financial system can do. So as a consequence, the financial system, or the so-called abstract market, FSAM I call it here, defines the real economy And what we'll explain now is how it does that. It does that by specifying what we call the cone of acceptable losses. When market clearing is possible, one can attain positive aggregate excess supply, and there's no loss exposure around because everything that is promised can be delivered because the supply dominates the demand. And so you get market clearing. But if you live in a world where there is a necessity of loss exposures because you cannot cover all contingencies, then the FSAM must define the set of acceptable loss exposures. Because you cannot say, I want positive excess supply, because it's just constitutionally not possible. And so you have to say, what are the acceptable loss exposures? And this is done by defining a small cone that contains the non-negative random variables. Of course, if you can get positive excess supply and it's non-negative, that's great, you would want it. But if you can't get it, then what will you take? And the abstract market says that it will accept all random variables that lie in a small cone containing the non-negative random variables. This is the financial primitive of the model, the definition of the cone of acceptable losses. Now, all such cones of acceptability can be characterized mathematically in a very simple way. Every cone of acceptable risks is equivalently defined by a set of probability test measures. And you basically take, like the Federal Reserve does, give the banks a whole bunch of scenarios and compute expectations under all the scenarios. And if you're positive under, if you have positive expectation under all test scenarios, then the random variable or the loss exposure is acceptable, otherwise not. So this becomes the test for acceptability. And so the small cone is the financial primitive, and it replaces what is meant by clearing. Clearing does not any longer mean positive excess supply. Clearing means that excess supply belongs to A star, because then the financial system approves the loss and says, I will take care of it if it happens. So aggregate excess supply may fail to be non-negative, but they must belong to the cone of acceptability. So that's the financial primitive of the model. Now, what happens in this model is that you get a two-price equilibrium, and it comes as follows. All economic agents transact with the financial system or the abstract market, and everyone sells their endowment to the financial system. Greece sells its endowment and then goes and buys what it needs. So all transactions are with the market or the financial system, and you sell your endowments to the market and then buy what you need. The financial system offers individual participants, however, a larger cone than the small cone in which excess supply must belong, because you want to give people, try and get as close to the law of one price as you can and give them a low ask price and a high bid price. And so you want to give them a large cone of acceptable risks defined by a smaller set of test measures. So you try to give the economy a big cone with the qualification that the aggregate excess supply must belong to the small cone. So the financial system or the abstract market sets prices, a bid price at which you can sell to the market, and an ask price at which you can buy from the market. The market sets for all random variables a bid and ask price for buying and selling X respectively. So the market then says, okay, you want me to sell to you at the bid price, so you give me your endowment, and I will offer you B of X for your endowment. So I'll pay you B of X for your endowment. And if you want to buy some things from the market, then you pay the ask price and I will deliver the X to you. But both of these things must be acceptable, must be in the large cone of acceptable transactions. So that statement, requiring this to belong to A, leads fairly quickly to the law of two prices, whereby the bid price of the market is the infimum over all test evaluations, and the ask price is a supremum. And so you basically end up with a two-price equilibrium in which you learn how to compute the two prices. Once you've specified the set of test measures, the bid price is infimum, the ask price is supremum. And the job of the Walrasian auctioneer in a two-price economy is to find the set of test measures to be applied, the big cone to be given, to find the pricing rule. But the pricing rule is not one number anymore. The pricing rule is two functionals. But to find the pricing rules in such a way that aggregate excess supply belongs to the financial primitive, which is the small cone. So that's how the two-price economy comes into existence. Now, technical remarks on the two-price functionals are as follows. Unlike the classical valuation functional of one-price economies, the valuation functional for two-price economy is nonlinear. The one-price economy just has a single linear functional, the risk-neutral valuation operator, and it just gives you a linear valuation function. The valuation function of a two-price economy is an infimum and a supremum, and so it is nonlinear. The bid price is a concave functional, while the upper or ask price is a convex functional. So you get nonlinear valuation operators out of this, which is nice, as we'll see, I'll mention in a number of applications. Now, in terms of these two-price functionals, I point out that you only need to understand one of them, because you can always construct the other one from the relationship between sup and inf. So you know that the sup is minus the inf of the minus, and so if you know how to build bid prices, you can always build ask prices as the negative of the bid of the negative. So I will focus attention mainly on just the bid price functional. Further in the talk, I'll just talk about the bid price. Now, those are technical remarks, but financial remarks are as follows. I say that, we have not delivered to the world objective function for firms, for corporates, for enterprises. We've been studying humans for a long time. And I say individuals on an isolated island comparing actions with uncertain consequences may allow the dictates of rational behavior under uncertainty, may follow the dictates of rational behavior under uncertainty, and seek to maximize expected utility. These are people comparing gambles, sitting and thinking about them. They are not becoming aware that they are living in a financial economy that regularly values human and economic activity. And in such an economy, maybe you should pay attention to market value. I tell my students that if they wanted to maximize expected utility, they would probably go skiing or take a holiday or have a party. They would not be in my class. They come to my class to try and maximize market value. And so we should be thinking about delivering financial valuation operators to the world and not necessarily expected utility maximization. And in fact, if you maximize expected utility and the market takes your stock down, that's not very rational. So the lower price functional, I point out, is the concave functional. The linear functional that you had from classical one-price theory is not a good valuation functional, because to maximize a linear function is to run to the edge, to run to the extremes, run to the constraints, because that's all you can do with a linear functional. The gradient never changes on you, so you keep running. Okay? It's nice to have a concave function to maximize. And the lower price functional is basically just a conservative valuation operator, and that conservative valuation operator is ideally suited as an objective function for designing actions for corporates and enterprises. In fact, I use them now to build trading strategies for hedge funds, for banks, for all kinds of places. And in fact, we can now show that suppose you have a person who has maximized expected utility and is sitting in a position where they're done. They don't want to do any more trades. They've maximized their expected utility. But then you ask them, would they like to adjust their position from a value maximization perspective? And you shall find, yes, there are things they want to do that would increase market value and take them away from utility maximization. And so it gives you a way of basically looking at how to design things for enterprises. Now, I say, let's go further and think about our lower price functional. Yes, we've decided what it is. We know what it is. It's this guy. Oh, I have to go back in steps now. Okay, but it's this guy. This guy. This guy you can talk about, you can write papers, prove theorems, many are done. But for me, it's not very satisfactory because how do I compute it? I need to make this operational. If I can't make it operational, I can't compute it, then I'm not satisfied with it. And so the real task is operationalizing the pricing functionals of a two-price economy.
In the previous equations, there's n, and we are assuming that each side and other side will belong to the same space of the n. But in real market, actually, we see some case there only bid or there's only offer, not bid and offer. So,
right. In a two-price economy, from the model, you will always get two because the minute you write down your set of test measures, you will get the two. Oh, sorry, I went too fast there. Yeah, we were here. I want to operationalize this. So we need to get specific about the set M. What is this set M, and how can we make the computation of the lower price functional? Now I say we are building a valuation functional, so it should contain at least one risk neutral measure. And so I start there. I typically pick a risk neutral measure. Working with options most of the time, I calibrate these from data on option prices for various underliers that I may be interested in. Sometimes I'm working with 9 or 10 of them simultaneously, trying to model the absorption of the market risk for, say, a pension fund, leaving them, or for a life insurance company, leaving them with the actuarial risk, and we take over the market risk. So we typically build a risk-neutral model to start with. And then we ask the question, what are the cones of acceptability that are possible when acceptability is going to be defined just based on the probability distribution function under Q star? So you pick one risk-neutral measure, and then you say, okay, I have a risk, it has a distribution function. How do I define acceptable risk given this distribution function? Now, it's not a good idea always to define acceptability for humans in terms of the distribution function. I give the example that, let's say, next Monday, I'm homeless, or next Monday, I'm a billionaire. And maybe those two events have the same probability law. I'm as likely to be a billionaire next Monday as homeless, hopefully. They have the same probability law, but if you offer me $1 million when I'm homeless or $1 million when I'm a billionaire, obviously I'll prefer getting the million when I'm homeless to getting $1 million when I'm a billionaire. I have issues. I'm a human. But the market, abstract market, is not a human. It's like the corporation in the Arrow de Brue world. It's not a human. Corporations, I mean, yes, we have the Supreme Court saying that corporations are humans. But corporations don't drink wine, don't rent rooms in hotels, don't eat nice cakes. Corporations are not humans. And the abstract market is not a human. The abstract market is just only concerned with trying to get into that small cone to get as close to market clearing as it can. And so I say, at least as far as modeling the abstract market goes, maybe it's okay just to look at the distribution function because the abstract market doesn't have issues. So once you restrict attention to the probability law, then Kusioka, 2001 paper in Math Econ, showed that if we demand acceptability be defined solely in terms of the distribution function, that's step one. And second, we add the condition that there is linearity somewhere. It's not the case that this function is strictly concave and you get that the bid of the sum is bigger than the sum of the bids, but that there is linearity somewhere. And that somewhere is for co-monotone risks, namely when essentially x is a monotone function of y, then you have linearity. So if you accept linearity for co-monotone risks and just work with the distribution function, then basically Kusioka got this nice result that says that there is a concave distribution function that you can construct, and x, your random variable, is acceptable if and only if it has positive expectation under concave distortion. So you take your distribution function, compose it with this concave distribution function, then compute expectation. Positivity of expectation under concave distortion defines acceptability once you have the two properties that we put there. So in this case, the bid price just becomes a nice, simple computational object. You just take the integral minus infinity to plus infinity and compute the expectation under the distorted distribution function. So that is an operational way to go there. You might ask what are the set of supporting measures, and they can be characterized. They are all probability laws on the original underlying filtration with the property that the probability of every set is bounded by the distortion applied to the risk neutral probability that you started with. So you start with one Q star, compute Q star of A, take psi of that, and then the set M consists of all probabilities Q meeting this condition. So we understand the supporting measures and we understand how to compute it. The question then turns on what distortion to use. And the first distortion that I decided to use was this one. 1 minus u to the 1 plus gamma. And that distortion was very simple to explain in English. It just says that the random variable x is acceptable if the expectation of the minimum of gamma independent draws from the distribution is positive. So you draw from it 100 times and the expectation of the minimum of 100 draws is still positive, then you say it's acceptable at level 100. That's a reasonable way of looking at acceptability, basically maximizing some worst case. Another choice which we made was u to the 1 over 1 plus gamma. So this is in papers with Alexander Cherney in 2009 in the Review of Natural Studies. So that was the second choice. And this choice is a little contorted, but still possible to explain. You say that x is acceptable just if the expectation is positive under a distribution function g that is so lousy that you have to draw from it gamma times and take the maximum outcome to get to your f, okay? So it's so bad that you have to maximize draws from there to reach your f. So then take expectation under g, and that's what you get when you pick this distortion. Now I threw both away for the following reason. Expectation under concave distortion is expectation under change of measure, because you just take d psi is psi prime and then the derivative of cap f is little f. So this is your original probability and this is your change of probability. So expectation under concave distortion is expectation under change of measure, and the change of measure is the derivative of the distortion taken at the quantile. Now basically I want, that's the change of measure, and I basically wanted psi prime of 0 to be infinity. I don't want to say that you made a $10 billion loss and my dissatisfaction is about 2, okay? I want psi prime of 0 to be infinity, and I want psi prime of 1 to be 0. So I want to discount gains and reweight upwards losses. And we basically recognize that if we put the two together, the u to the 1 over 1 plus gamma and then the other one, then We call gamma the stress level of the distortion, and then you basically get both properties. You get both these properties. And so I've been working mainly with this distortion here. Now, in terms of actually computing, it's very fast and very simple. You take a simulated outcome of your cash flows, and then you arrange them in increasing order. And so you just sort them. So you simulate your cash flows, you sort them, and you compute a sum. Basically, this will then give you a computation for the distorted expectation. And so it's easy to work with. No, it'll be positive or negative, doesn't matter what they are. I mean, you work out the distorted expectation. If it's all positive, it'll be a positive bid price. If some are negative, it'll be a negative. So you can work with whatever, yeah. Then I said, okay, I know how to work with these things in a static one-period model, but then I wanted to actually do it in time, over time, and to build dynamic bid and ask price functionals. So we did this, and given a Markovian environment with states xt and transitions to states xt plus h in a time step of h, you have a risk-neutral transition probability q. That's your original thing that you extracted. So you built your risk-neutral Markov model, and you want to construct a lower price functional at time t. We work backwards in time from the end where you know everything. So let's suppose that you have your bid price functional one time step later, and you want to construct the functional at the time step now, the current time step, and maybe you have some intermediate cash flows that are coming along as well. Then you say, okay, the bid price is first, just take expectation. Okay, you take expectation, that's the cash flow coming in, that's the value afterwards, lower conservative value afterwards, compute expectation. Then to that expectation, you add a risk charge. And the risk charge is, okay, scaled by the time step, and then you take a distorted expectation. And the distorted expectation is, of course, of the random variable that you are looking at one time step later, mean corrected. Okay, so you take the mean, because you've got the mean over there already, so you take it out here. And then you take the distribution function of the mean corrected random variable, and then that becomes the probability distribution that you distort to compute the bid price. And so this thing has zero expectation because it's a deviation from the mean. And when you distort, you're reweighting losses and discounting gains, so this will be negative, and so the bid price will be coming down. The bid prices are coming down, the ask prices are going up. So this gives you a pricing operator related to nonlinear expectations theory. Now this sequence of way of constructing bid prices actually turns out to be what's called a dynamically consistent lower price functional, and it's related to the theory of nonlinear expectations. And so here's a small slide on nonlinear expectations. Nonlinear expectations are a family of operators. They satisfy all the properties of conditional expectation that we had. Basically, nonlinear expectations theory says, give me conditional expectations, but I don't demand they be linear functions. I want all the other properties. So you ask for this operator. It takes random variables defined on the terminal filtration and maps them down to ft, f small t measurable variables. And so this x is big X is cap T measurable, this guy is small t measurable. And we ask for monotonicity. If x is bigger than y, the conditional expectation of x is bigger than the conditional expectation of y. If x is t measurable, then it's a constant, it is known, and so the conditional expectation should be itself. The Tower lemma, we ask for, if you've got s less than t less than cap t, then you can go straight to s, or you can go to t and then go to s, and it should match up. So this is the iterated expectations property. And finally, we ask for, you can take out the indicator function of an ft measurable event. And that's basically nonlinear expectations. Now, given a family of nonlinear expectations, and I'm pointing out that the bid price functional that we constructed here, this guy, is a nonlinear expectation, satisfies all those properties. And so you've got a dynamically time-consistent valuation operator. And then Shige Peng has now been looking and developing the theory of nonlinear martingales in a very natural way. Basically, you take a random variable capital X defined at capital T, and you construct its nonlinear expectation. If you had constructed its linear expectation, this would be a martingale. It's an expectation of a terminal random variable. Well, now you construct a nonlinear expectation of a terminal random variable, and you call that a nonlinear martingale. So nonlinear martingales are just nonlinear conditional expectations of terminal random variables. And so what we have here is a nonlinear martingale. And so bid and ask prices are nonlinear martingales. And so this I pointed out, and this is actually shown in the work of Cohen and Elliott in that paper, where they show that these functionals, well, I mean, I show, referring to their paper, that these functionals satisfy the conditions required to solve backward stochastic difference equations, and the solutions of such are nonlinear expectations. So we have examples of nonlinear martingales in discrete time. Now I want to go to continuous time. I'm not happy with just sitting in discrete time. I mean, we know that we have tenor-specific prices of bonds these days, 1 month, 3 months, 6 months, and whatnot. But one would like to have pricing that doesn't depend upon whether you do your computations 1 day at a time, 1 month at a time, 1 year at a time. But you want to do it in continuous time. So how to go to continuous time? Well, the way to go to continuous time is to begin. It goes with the work of Shige Peng, but as a review, we start with the one-price theory in continuous time. When we look at the one-price theory in continuous time, the pricing functional of a one-price economy living on a Markovian filtration satisfies a martingale condition in, you can do it in reverse time if you like, and when you solve these things, it's better to work in reverse time. So you start with the functional being equal to payoff, and then you move backwards in time to get the value of the option or the value of the claim at other times before the final time. So it's better to work in reverse time. And so when you do that, you basically develop a partial integral differential equation. I mean, the Black-Scholes equation under a Brownian filtration related to the heat equation is the first one that we started playing with. But if you start working with jump processes and Levy processes and things, you basically develop a partial integral differential equation for your value functional. Your value functional basically satisfies an equation like this, where L is the operator connected with the infinitesimal generator of your Markov process. So you're satisfying an equation like this, subject to a boundary condition like that. And it's good to put this boundary condition at time 0, because then you can, when you go through forward time, you can just keep going and compute the values at all future times. So that is how valuation works in the one-price theory. And in particular, if I'm working with a pure jump Levy process, as typically I would be doing, then there is a drift parameter, there's a Levy measure, and defined for the jump size is unequal to 0, and your explicit infinitesimal generator that is going into your equation for solving for your value is of this form. And in this form, the interesting thing that we're going to be working with and playing with and making nonlinear is the integral operator. So the integral operator over here is integrating over jump sizes, where you're multiplying the response of the value function to the jump up to, say, taking out first order. You're looking at the response of the value function to the jump, and then multiplying it by the arrival rate of the jump and integrating. And then that's your operator, and then you put it into the partial integral differential equation and solve your value function. And when you do this, you know that what you have done is computed conditional expectation, linear, normal, ordinary conditional expectation. Now we will connect up with the work of Shige Peng. And Shige Peng said that the infinitesimal generator L, of course, is a linear operator. And Peng, 2006, built G expectations, defined G Brownian motion, and created these G expectations as solutions of nonlinear differential operators. So we will work with integral differential operators because I'm working with jumps, but he was working with G Brownian motion and just working with no integral term and just a second order derivative, but done nonlinearly. So basically, if you take as your value function some boundary condition, and then you solve a nonlinear integral differential equation, then you build nonlinear expectations and you build nonlinear prices. So the result in this case for your solution is scripty nonlinear conditional expectation. So this is a nonlinear expectation, and that's how it's computed. And to basically do it, you need to write down what is your nonlinear operator. So basically, I just need to describe the operator, and that's done as follows. I knew that I have, I know that I have this response to a jump of my value functional. That's going to go into computing the derivative. And it's multiplied by k of y. Multiplied by k of y. And at this point of the development, I did not know how to distort anything but a probability. I have a concave distortion that I can apply to a probability. Give me a probability and I can do something. Without a probability, I can't do anything. And this k of y, unfortunately, typically is not a probability. It does not integrate to 1. It integrates to infinity. For a gamma process, variance gamma process, many processes I work with, integrates to infinity. Is not a probability. So I said I'm going to force a probability into view. I'm going to force it into view by multiplying by y squared. Every process we work with has finite quadratic variation, and so once you multiply by y squared, the integral will be finite. And so you can divide by the integral, that's finite, and this becomes a probability. So now, to force this into view, I'm going to multiply by y squared and divide by the integral. So of course I've got no business doing that, so I do the opposite, multiply by the integral and divide by y squared. So I change the response function of the jump by deflating by y squared, inflating by integral, multiplying by g, which is done the reverse, so I haven't changed anything, everything is okay, but I've forced a probability into view. Now I have g of y positive integrates to 1 is a probability density. Now we can rewrite our operation as an expectation, and that's done very simply. Define this random variable, which is the jump response, appropriately inflated and deflated, and then construct its distribution function under G, where you define A to be the response is less than V, and you construct your random distribution function. Under the G probability, you construct a distribution function, and then your integral is just a expectation. Your integral is just an expectation of a particular random variable with respect to a particular probability, and now you can distort. Now you introduce your distorted probability, and that can be rewritten in this form, which is basically applying a distortion to the lower tail of your distribution function and applying another kind of distortion to the upper tail. 1 minus that is the upper tail. And so you're basically playing with two tails and looking at distorted integrals. And now you get yourself a nonlinear. This is all a nonlinear operator because the expectation that you're applying it to depends upon the variable you're applying it to. And so this is a nonlinear operation. And so you basically come up with a nonlinear differential operator. And you solve this equation, which is your nonlinear bid price in continuous time. So you can basically build nonlinear bid prices in continuous time this way. Now, the thing was that I was forcing a probability into view, and I wanted to basically be able to do this in general when I have a full Levy measure and it integrates to infinity, and I want to go directly to measure distortions. So if you take your distorted expectation operator that you have, first you just look at the distorted expectations, and then we'll look at measures. So you take your distorted expectation, which is this. You do integration by parts and rewrite it this way, which is the rewriting an expectation as a Choquet integral. So you're basically applying the distortion to the area below, and then you're applying 1 minus the distortion, 1 minus psi of f of x. So you can write it like this. Now, it's nice to rewrite it in a symmetrical way for the area above and below. So we will play with that and make it symmetrical. And we do that as follows. Basically introduce the upper tail measure as 1 minus f, and then introduce the complementary distortion, which is 1 minus psi of 1 minus x. So you introduce the upper tail and the complementary distortion, and you can write the distorted expectation as, in a symmetric way, it's an integral of a distortion applied to the lower tail plus a complementary distortion applied to the complementary lower tail, which is the upper tail. So you take the upper tail, distort it with the complementary distortion and integrate, take the lower tail, apply the distortion, integrate, and you've got your object. Okay, so that's how you can compute distorted expectations. Now some remarks on the two distortions and the complementary distortion. And that works as follows. Both distortions are increasing in their arguments. Both psi and psi hat are increasing. Psi is concave and bounded below the identity, bounded below by the identity function. And psi hat is convex and bounded above by the identity function. So basically, psi is concave going like this, and psi hat is basically the same thing being looked at from the other side. So if you take a concave function and you look at it from top, it's a convex function. So psi hat is just the psi looked at from above. And so psi is concave and sits above the 45-degree line. Psi hat is convex and sits below the 45-degree line. So basically, psi is concave and bounded below. Psi hat is convex, bounded above. And for the bid price distortion, one employs the concave distortion for the losses on the negative outcomes, and one employs the convex distortion on the gains. Having learned that, I make some comment about why it is useful, but we then learn how to go directly to measure distortions. So supposing I have a Levy measure that integrates to infinity here, and I want to compute an expectation of something with respect to that measure, and there's no probability around. Well, I can rewrite that as integrals over tails. So this is just change of integration by parts, and you can rewrite it as an integral of lower tail plus an integral of upper tail. Same measure. Okay? And now we're going to introduce our distortions. To the lower tail, I'll apply my concave. To the upper tail, I'll apply my convex. And so you introduce two functions, gamma plus and gamma minus, defined on the positive half line, that are 0 at 0 and increasing, respectively concave and convex. And the first one is bounded below by the identity function, second one bounded above by the identity function. And then you can take your two functions and do a distorted computation, where you apply gamma plus to the lower tail, gamma minus to the upper tail, and then you can basically compute a distorted expectation. And this is the set of supporting measures. But the real point here is that you can replace measure integrals by distorted measure integrals in defining big G expectations, and then get solutions of nonlinear partial integral differential equations, and that gives you a two-price theory in continuous time. Yeah, okay. Now, examples of measure distortions. After all, I can't do anything until I can actually compute some of them down. They're very easy to construct. Basically, you can construct the upper concave guy, which has to sit above the 45-degree line, as x plus basically a probability distortion applied to 1 minus e to the minus cx. So 1 minus e to the minus cx maps the whole half line to the unit interval, and then you compose it with a probability distortion, and that gives you a measure distortion. So this x sits on the half line, and it's a concave function. It's increasing and bounded below by x. This guy is convex because minus a concave is convex, so this guy is convex, and it sits below because you've subtracted, and so you basically apply a probability distortion again. You can pick the same or you can pick different ones. Typically, I think you need to pick different ones, and so you can pick your probability distortions and construct your measure distortions, and so you have the equipment and methodology for continuous time two-price modeling. Now I'll say some remarks about nonlinear martingales and their relationship to no arbitrage. So in any two-price economy with securities traded with the market at its two prices announced continuously through time. So supposing you have a two-price economy, everything has got a bid and an ask price, a lower and upper price, and they're all sitting around, they're being quoted every day. In fact, you can go on the screens and see structured products and see their bid and ask prices continuously through the day. They're all being generated. And suppose this economy is free of arbitrage. Then one can show, there's a paper by Leguini, another paper by Paolo Guasoni that has looked at this issue and have shown, and I've looked at it in small discrete time models, and you can see that this economy is going to be free of arbitrage if and only if there exists a measure that values the trades continuously between the bid and ask. You must have a measure that remains between the two all the time. Arbitrage free means that there is a valuation operator that sits between, in the spread, sits inside. Now you can define risk acceptability as positive expectation under all such measures. There is one that sits between the bid and ask. Define acceptability as positive expectation under all the measures that sit in the middle. Then the lower prices will turn out to be nonlinear martingales, defined as infima of conditional expectations with respect to that set of measures we just spoke about. So you will get your bid price as a nonlinear. You will reenact your bid price as a proper nonlinear martingale. And so I say nonlinear martingales are to no arbitrage in two-price economies as martingales are to no arbitrage in one-price economies. Now, this hasn't been proven, but I'm seeing enough of it, enough of the structure to anticipate that we will have a proof one day. But these things, you know, you see the thing long before you prove it. I mean, that's life. Now I'll comment on using these things in a variety of different ways. I still have some time. Remarks on risk-weighted assets. So risk-weighted assets are essentially, I was always surprised when I looked at risk-weighted assets and they said the risk weight for cash is 0. And the risk weight for other things, 50%, 40%, whatever. But the picture of risk-weighted assets is that they're actually not assets. They're the part of assets that could go away. They are assets that could be lost. And then, of course, you can't just have assets being applied, risk weights being applied to assets. People eventually realize that they've got to do something about liabilities. And so they say you have an add-on for liabilities. So when you're really talking about risk-weighted assets, you're talking about what can be lost and what you might have to pay in addition for an unfavorable unwind. So you can use the mathematics of two-price computations in static models, discrete time models, continuous time models to define risk-weighted assets as the risk-neutral expectation minus its shaved value plus the ask price less the liability value. And so you basically get analytical, mathematically operational ways of defining risk-weighted assets rather than just saying this one is 50, that one is 60, that one is 22. Okay? You get a way of looking at risk-weighted assets from two-price theory. The relevant prices, of course, are the bid and ask prices from the valuation operators of two-price economies. And the modeling could be static, discrete, or continuous. Remarks on capital. In a paper with Vicente Alvarez and Peter Carr, came out in Journal of Risk, we were looking at capital charges on risk exposures. Typically, in standard models, of course, you don't have to worry about capital charges for risk exposures because there isn't any risk exposure. You're in a complete market economy. You can completely replicate the thing, and you will earn what you promised to deliver. What do you need capital for? You don't need capital to cover losses because there won't be any. But if you do a simple computation in the presence of risk exposures where you know that you're exposed to losses and you consider what capital charges, what capital you should be charging, you can note very quickly that if you have enough money to cover the unwind, you have enough capital, okay? And this is what you get if you apply the theory of acceptable risks to define capital adequacy, and these are in papers by Freddie Delbayan and others. Defining capital this way, and you get the ask price as being the capital. And so I looked at that, I computed those numbers, but I said, you know, that kind of computation will destroy capitalism. It will make capitalism dysfunctional because the capital numbers you'd be putting out are so large. A guy has got a trade on worth 100 and you're saying he needs 105 capital to do it. That's ridiculous, okay? So I said, that's too hard. That's impossible. We cannot compute capital this way. And I say, you should at least give credit for the bid price. At least the darn thing is worth the bid, okay? And you need the ask to basically be able to unwind. And so just ask for the difference. So if you ask for the difference between the two prices of the two-price economy, you have a definition of capital required or capital charges. So the two-price economy functionals provide definitions for risk-sensitive capital. And then when you come to hedging considerations, you're hedging in incomplete markets, you can't cover the risk exactly, you can hedge to economize capital. So you can compute capital charges and pick up hedges that will economize capital. And here you get an alternative to variance minimization as a hedging objective. Variance minimization is a criterion with no parameter, expressing your attitude to how much hedging you want to do. Here, if you do it with capital charges, there's a parameter in the distortion. And so you get parametric objective functions for capital management. Of course, the bid price itself is a functional for, as I already pointed out, for value maximization for enterprises. So you get something for enterprises and you get something for hedging. Remarks on marking to market. I say in general, marking to market should be interpreted as marking to two-price markets. And assets should be marked to bid or the lower price, while liabilities should be marked to the ask or the upper price. In a paper on Steberlein and Tom Gehrig that appeared in the Journal of Risk, we show that the sensitivity of ask prices for debt comes down significantly in terms of its response to moves in CDS rates, and therefore the DVA charges are significantly reduced. Basically, the DVA charges that are basically asking firms to take profit from their inability to meet their obligations, not a very satisfying thing. If you just value your liabilities at ask, those charges will be significantly reduced. Those profits will be significantly reduced. In a paper with Wim Schoutens, we look at the effect of two-price on the optimal debt. And here I might point out that the two-price theory is relying on what are the cones of acceptable risk in different markets. And I was pointing out earlier to people that, you know, if you look at when Morgan Stanley did the financing for Dulles Airport, the number of securities that were issued and the number of markets that one went to was quite large to raise the money for the financing. So in the actual world, of course, there are many, many securities, not just debt and equity. And we build so many every other day. Now, the further risk management implications of the two-price theory are in this paper that came out in Annals of Finance last year. And really, I would point out that, before I conclude, I would point out that people that I work with from the insurance area, they have been looking for, asking for, and talking about getting a theory of liability valuation that was separate from asset pricing. And you get a theory of liability valuation here because you take your two price functionals. They are proper solutions of nonlinear partial integral differential equations. And you can do your liability valuation at ask while you do your asset pricing at bid. And so you separate a theory of liability valuation from asset pricing, and you have conservative valuations on both sides, and you keep capital reserves against unfavorable unwinds on either side of the balance sheet. So I say finance is critical for an economy, as no one is approved for trade without it. In fact, there is no economy in its absence. So you turn Modigliani-Miller upside down. Finance is not irrelevant. Actually, traditional economics is irrelevant. Between too big to fail and too small to deliver, I think we probably better go with too big to fail. In the old days, we used to have many, many banks, and the only big credit card issuer was American Express. And then we began to get many entities that could do that job because they became TBTF. Financial operations necessitate a formal understanding of acceptable risks or approved trades, because financial operations are approving people for transaction and taking the exposure to loss that comes with it, and then how much exposure should be taken is critical, and so you need to define acceptable risks. So finance comes with a financial primitive in the model, and with that primitive, the consequence is, of course, a two-price theory. So markets clear with two prices. They clear in the sense that you go to a small cone. You don't clear in the sense of getting non-negative, but you clear. And then this material can be operationalized using probability and measure distortions applied in discrete or continuous time. And the two-price theory leads us to nonlinear martingales and provides a new perspective to issues of risk-weighted assets, capital, and marking-to-market. And that's basically the full length of it. I think there were 135 slides, but I thought there was enough time here. Okay, so with that, I close. Yeah.
So RWA and capital, well, probably there's some link or dislink between the theory and like Basel III rules that is actually forcing the financial system. And I want to see your opinion on this link or dislink.
Well, so in my reading and looking at the evolution of Basel III rules, it was really people forced to understand and make rules about how to handle various kinds of risk exposures that come through naturally in trading and in operating economies. And in my view, they get very little help from the academic world, which lives in another corner where markets are complete and none of these issues come up. And I comment sometimes, you know, that there's a campus world where there's a publish or perish incentive. And if you want to publish, you want theorems. The best way to get theorems is make strong assumptions, very strong assumptions, because then you can prove a lot of stuff, okay? And so you go with that, and you get tenure, and you get promoted, and you become top professor and everything. And you've been swallowing these assumptions for so long that you even forget they were assumptions. Okay, you just live with them. And then there are people in the rest of the world out there asking important questions, difficult questions, and nobody's helping them. And I'm saying, okay, you know, we can try to get rid of those assumptions and try to help the world in that. And that means to come up with risk-based charges, capital charges. Actually, one would like capital charges that are pro-cyclical, so that they go up during a boom and come down during a bust. And I have shown in some papers that if you calibrate the stress parameter of the cone to market bid and ask prices, then during a boom, people are getting nervous about the coming bust and nervous about the inventory they're having to hold and increasing the spreads on the trades. And you can actually pick up signals for increasing capital for a pro-cyclical capital formulation. And so this does lead to some pro-cyclicality in capital defined this way. And so it is looking at the questions that Basel is concerned about, but approaching them with some analytical risk-sensitive structure. Now, of course, another funny thing is that you get in those documents people saying, we want risk-sensitive capital, but you're not allowed to model the risk. Now, how do you get risk-sensitive capital without modeling the risk? Well, we just write down rules. Mortgage, 50% risk weight. That's risk-sensitive capital, but you can't model the risk. This looks weird, and so people say, no, we should be able to model the risk, and finally they concede and let you model the risk. Of course, what they were worried about is that you model the risk in your favor, and you model the risk to reduce your capital requirement, and that was the reason why they said you can't model your risk. But then, you see, the FAA sets weight limits on flights. It doesn't let the airline set the weight limit. The FAA sets the weight limit. And capital charges and understanding how capital should be set and managing leverage policy in a modern financial economy is something that we should be seriously paying attention to and doing. And you need analytical structure for that, and this kind of theory delivers that kind of structure. And one can build a FAA-type body that manages capital instead of letting people trade and manage capital and talk it down left, right, and center, as they do by enticing people with commissions and say, cut it down. And so you have those kinds of things. So yeah, there are connections. Yes?
Yeah. You made a comment about the idea that there should be capital reserves against unfavorable unwinds. But is there a formalization in this process, in the two-price theory, describing the fact that bids and ask prices represent bids and ask prices in markets of finite depth? The bid is for a certain number of items. The ask is for a certain number of items.
Yes.
And if you go beyond that,
Right.
now you don't have two prices.
I agree. I have done work and written about prices that depend not just on the direction of trade, but also on the size of the trade, and also on how fast you want it done, okay, on commitment. And basically, if you change the definition of acceptability from a convex cone to a convex set, you will then get size-dependent pricing. And so that's the next step, and lots of people writing on that kind of arena, but I was saying that I'm talking to so many people living in the law of one price, that to just begin by talking about two is enough. If I come there with size-dependent and delay-dependent pricing, they will just tell me, go to sleep. I mean, they're not going to listen. And so I said I will take just one small step to start with and focus just on direction.
Other question. So probably it's short of my understanding, but my analogy is, let's say I have a Black-Scholes model and I calibrate to it, and if I bid price my option that is used for my calibration, actually there's no meaning it is going to match the original price. And here we are approaching like a two price and bid and ask, and in reality we'll see a lot of bid price and ask price for n number of securities. And in practical terms, how we can use this observability of bid and ask for N securities and doing something more.
Well, so one of the things you see, like for many years, for 15 years, I've been calibrating option pricing models to the mid-quote. Okay. Actually, the database I work with has the bid and ask prices there. But we compute mid-quote, and then we say that's our candidate for the law of one price. In another paper, I show that if you use the mid-quote as a candidate for the law of one price, you will find arbitrages everywhere. Put call parity will be violated and everything because the mid-quote is not the risk-neutral expectation. However, more recently, since I now know how to analytically price bid and ask from the underlying risk, I calibrate directly the stochastic process underlying the risk and the parameter of the cone to the observed market bid and ask prices. And so then you can use that information, and that's how actually I was building pro-cyclical capital requirements, by basically calibrating to market observed bid and ask on S&P. But you can do it on all the other assets as well. I mean, and of course you see bid and ask prices for all structured products and other things as well.
So we can use bid and ask to calibrate the cone.
Yes, you can use bid and ask on options to calibrate the cone parameters. Yeah, and typically I would be using just the out of the monies, not the in the monies. But that's a normal thing. So we're right on time. Thank you.